Still with us, Jens Nordvig of Exante Data. We were talking about consensus trades earlier, this idea that there would have been so much consensus that there would be some deal on Brexit, that's what you're seeing today as sort of a cooling in that. You're also seeing a consensus about a weakening dollar. Do you think that that has gotten overplayed as well?
Oh, I think certainly from a short-term perspective, we can see it in all the different positioning indicators that we track, that the CTAs are very short dollars, macro funds are very short dollars. So there has been a bit of a froth. I think if you look at it from a medium-term perspective, typically the dollar moves in sort of cycles that are driven by global growth, right? So the key thing that's going on right now from a medium-term perspective is, are we actually having a sort of growth recovery that is linked to the vaccines being deployed on a broad basis? If that's the case, then probably the medium-term trend is a very powerful one, and that warrants sort of less tactical trading. But it doesn't mean it can't be painful for a few days if we have bad news like this or anything other thing that's going to generate risk aversion.
Jens, what does that actually mean for dollar? Are we going to see a significantly weakened dollar from here?
I think the most important variable for the dollar is really what's going on with global growth. That tends to dominate, for example, what's going on with U.S. monetary policy. And therefore, I think having a meaningful move is very possible in this cycle. Also keep in mind that we've been in a strong dollar environment really since 2014, right? So we've had a 6-year period where the dollar has traded very well. We've gotten to strong valuations, right? So the dollar has now been weakening for about 6 months. But there's a lot of positions out there. For example, European real money investors have accumulated a lot of US dollar assets. It takes time for them to hedge those assets better. And I think we're only sort of halfway through this process of hedge ratios shifting. And that means that this dollar move has legs unless something bad happens on the way. Like the worst case scenario, I think, is that we have some bad news about the vaccines not being effective. That would really shake the notion that global growth is recovering.
But Jens, what about euro dollar? So could we reach 125 on euro dollar, and how problematic would that be for the ECB? Could they do something about it?
Yeah, so I'm getting that question, if not daily, then very, very frequently. And it's true that obviously from the ECB's perspective, they want to get inflation higher. They're way, way below their targets. So stronger currency is not helpful. But on the other hand, I think the Europeans also want to make sure that there is a degree of coordination globally around not interfering in currency markets. So it's very hard for them to do something that's too explicit. And if you think about it, like what is a very strong level of the euro, right? In 14, we traded 140. Like the levels we've been getting used to in the last 2 years are very, very low levels, and therefore a level to 125 I don't think is something that's totally game-changing for the ECB. And I don't think that you can say, okay, I don't want to be long the euro at all just because of that ECB concern. I think there are other forces that can dominate any short-term rhetoric by the ECB on this front.
Well, Jens, what could the ECB do if they wanted to weaken the euro?
Yeah, so I think the most effective instrument that they have that could drive the currency are the interest rates themselves, right? But it's incredibly controversial to cut deeper and deeper into negative. And there's a reason why the ECB has not been using that instrument for a while and has been focusing on the QE. And I think, and we think in the company certainly that PEP expansion is the way forward for them now, and that's what they're going to do. We think we've seen the last rate cut essentially in terms of the official rate and the deposit rate essentially. And this means that they can't do that much. The PEP expansion is not going to be that forceful in terms of the currency. Really, if they want to do something, it will be cutting rates further, but that is viewed as being too costly for the banking system at this point in time.
You know, it's interesting. In the past, a bigger debt load would indicate a weaker economy, or at least would potentially weaken the currency. And yet here we have that $2.2 trillion European Union plan that's being discussed. Will that actually strengthen if passed? Would that strengthen the euro, or would it weaken the euro?
I think it would absolutely strengthen the euro. I think we saw it very clearly in the May to July period, right, that the European Recovery Fund idea was a major reason why we moved from 108 in the euro to 118, right? And it has to do with the fact that The European Union, the euro was always seen as being weak because there was no common fiscal capacity, and this is one step in the direction of building common fiscal capacity, and that should strengthen the growth prospects and should enhance financial stability. So all those issues are actually positive issues, and they're positive for the euro as well.
Jens, what do you do with renminbi right now? So given where we are in U.S.-China, President Trump trying to maybe box in the Biden administration, although that could actually backfire because it gives him more leverage with the country. But how do you view on China and renminbi?
Yeah, well, so there's some really positive things going on in the Chinese balance of payments. For the first time ever, we have very significant inflows into the Chinese bond market. That's number one. Number two, Chinese tourists are not allowed to travel anywhere, so the money they used to spend globally is now being captured in China itself. So there's some big positive shocks to the Chinese balance of payments that allow the Chinese currency to strengthen. So the big question now is whether they're actually intervening in the market. So we had interesting data today. The Chinese currency reserves gapped higher, 50 billion in the month of November. So that could be a sign that they're starting to intervene. Some of our proprietary day-to-day models of intervention have shown a pickup in essentially FX buying, Chinese currency selling by official or semi-official institutions in China. So perhaps we have this sort of fundamental positive backdrop in China, but perhaps they're also starting to essentially engage in their own currency market again in a way to avoid that appreciation. So that suggests we're going to have a sort of grinding move as opposed to like a gap stronger.
Fascinating, Jens Nordvig, Exante Data founder and chief executive officer. Interesting to see how China on the margins is getting that uncomfortable with the strengthening.